The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Take. My name is Gaurav Sodhi. Joining me today is Angus Donohoo, and with us also is our analyst, Nick Cummings. This is, lucky the audience didn't hear all our outtakes because this has been a bit of a rusty opening for me. That's because Nick has hosted the podcast the last couple of weeks. You did a really good job, Nick. I think someone said the kids were in charge, and that's exactly what I felt like. But it was for the best. Well done.
I'm glad you're back. That's all I can say.
Now, before we get into anything too deep, you need to solve a controversy for us. Nike or Nike?
For me, it's Nike.
Oh, Angus, you got the tiebreaker.
Oh, I'm very posh. I call it Nikkei. No, I would say Nike.
Nike as well. Oh,
yeah,
okay.
but I think in America they just call it Nike.
Ah, so I've got the American of it. Should we do this one more time? Is it Porsche or Porsche?
Porsche, I think.
Porsche. That's what I would go with as well. All right. Okay. Well, we'll do Porsche another day, which I think is actually an interesting business in its own right, Nick. And I think it'd be an interesting research project for us anyway. I would love to go to a Porsche dealer and test drive a couple of Porsches in the name of research, of course, and have it all company pay. That would be great. But for now, we're sticking with shoes. You've been looking at Nike, which is a business that, for investing nerds, it ought to be something of a celebrity company, because one of the best company books ever written, Shoe Dog, is all about the founding and growth and success of Nike. And I think because maybe of that book, and also the subsequent success of the business, Nike has been something of a beloved stock, particularly among the high quality value investing crowd. But you've got some other ideas about it. Talk us a little bit about what you've seen when you've looked at Nike.
Yeah, I mean, I agree. Nike's a great business and a great brand. I think it sort of wrote the book on integrating brand image with genius marketing campaigns. I think Steve Jobs sort of acknowledged this and tried to replicate some of the same strategies at Apple. But I guess more recently, things have sort of gone astray. There's probably three big reasons I put down to. First is innovation has been lacking. The second is they've had a bit of a flawed direct-to-consumer strategy. And the third and most important is just there's been a lot more competition. So if you look at the innovation, I mean, this is a business that has a track record of really changing sports and shoe designs over the last 4 decades, and they've been the leader in this. But over the last decade, this has sort of changed, and other companies are now leading the charge. I mean, Hoka's came out with that new jogger that's almost like a moon boot. I don't actually like them. I tried them on and couldn't wear them, but other people love them. And Nike sort of almost benched innovation. They changed their strategy in 2017 to edit to amplify, and this put
edit to amplify. You have to explain that.
Yeah. Essentially, they put all their resources behind the best-selling products. So this is your Air Jordans, your Air franchises that they have, and they really just didn't invent much. They didn't spend a lot on innovation. They didn't bring out fresh designs, and so they weren't bringing that next customer through the door and building that next franchise, whereas other brands were. And this sort of worked for a while, but lately it's it's sort of come home to roost. I mean, the CEO blamed this on COVID a bit. He said, creativity can't occur over Zoom. And it's sort of a cop-out. I mean, he was the one that, sort of led this strategy a bit. It's it's pretty obvious creativity isn't going to work over Zoom, right?
It's interesting that he places so much emphasis on creativity, because I've always had this, I've never decided whether Nike is a design business, a marketing business, or a footwear business. And I guess when I think of creativity in this business, it's not in shoes, really. It's not in the footwear part of it. It's either in the design element or in the marketing element. Would that be the right way to think about it, or do you have another view?
Oh, I think it's historically, I would say I think it's been all three. I mean, in the early 70s, their co-founder Bill Bauman, I think his name is, was experimenting with a waffle iron and came up with a waffle trainer sole. They had an
fair enough. Okay.
They had an ex-NASA engineer experimenting with pressurized gas, and that's how they created that air technology.
I would argue that is marketing. I'm not sure pressurized air really does that much for you in terms of footwear. I really think that was a. Anyway, we're venturing off into a bit of. Yeah.
I agree. I think it's probably a bit of both, but lately that's been missing. And essentially, I think over the last sort of 10 years, maybe the last 5 in particular, this has been a company more run for profits rather than putting those other creativity and those design and almost the customer first. And it's now starting to slow down. So the sales fell for the first time last year since I think the GFC, and they're forecast to fall by mid-single digits this year. And if that forecast holds, that would be the biggest decline in sales for Nike since 1999.
Wow!
So it's a big slowdown in this business. And I guess as I was saying at the start, the competition has taken all the shelf space it's left behind. So it's really hard to slow some of these brands down because they have the momentum. They're winning the new customer, and Nike, I should say, isn't.
Yeah. Angus, let me bring you in here for a second. I reckon brand as a moat is no longer as powerful as it used to be, and that's largely because of the new forms of marketing and advertising are just so much more approachable and affordable for young brands. Is that a problem for Nike? Or is Nike just an example of one brand among many that are destined to fall, do you reckon?
I just sort of wonder if they've kind of hit peak saturation a bit. You go to a Walmart in America and you can pick up a pair of Nikes for like $30, and then you go to some sneaker store, like a specialty. There's all these specialty stores that sell like vintage Jordans and stuff, and these new limited release shoes, and they're like a premium product, and people will be paying $1,000 or more for a pair of Nikes. I think so. Like last year, $51 billion in sales. That's $6 per person on the earth on Nike shoes. Large parts of the world probably, well, maybe they can be wearing Nikes. It's been such an incredibly dominant, successful brand. But, I thought one of Nick's interesting points in his article was just sort of how kind of tired some of it's looking. Like I just did a little bit of a scan this morning on their, some of the stock, this retailers' websites, looking at that, and it's the same designs that are 20 years old, and they've got different colors and stuff. But when you're charging $200 for a pair of shoes, which probably I don't know what the unit economics are, but I imagine it's something like in the order of $5 probably to make a pair of shoes. At some point, can I see this doubling on sales growth? Can I see it being $12 per person on earth per Nike shoe? Probably not. I guess at some price, I think this is a great brand to own because I think it does, they're so ubiquitous. They're so saturated in across human culture. You go to any country in the world and you'll see people wearing them. But, at what point is it a good investment? And I don't think that point, I suspect that point isn't now.
Yeah, I think that's definitely how it's being framed in the market. I mean, on one hand, you've got this narrative of a turnaround. It's, trades at its lowest, valuation or lowest earnings multiple in the last decade. It's got a good balance sheet. It can reinvest in R&D. It's still a magnet for the world's, best athletes. And then on the other side, sort of to Gaurav's point, you've got potentially a declining moat here. And I actually think consumer brand moats are eroding. I think they're eroding pretty quickly. I think this is particularly the case in fashion. I think social media, online shopping as well, has just completely disrupted what used to be a significant moat. So an athlete or a celebrity now can have an audience of 50 million or 100 million and launch a product overnight get instant feedback. They can sell it online through a Shopify even and Amazon that cover all the distribution for you and all that sort of stuff. They even have their own advertiser, Amazon ads. And it's just so much easier to launch a brand.
You just described, Nick, exactly what Federer did with OnCloud.
Yes,
that's exactly what he did.
Yeah, and he left Nike right in 2017. And, Tiger Woods has left Nike. And so there's evidence here that, athletes or their sway over athletes is, far less than it used to be. And that's mainly this because athletes can launch their own brands now, or even if Nike does win them over, they have to pay more than they once did for them.
Yeah. One thing that seems to be a bit of an advantage for them is that the competition seems to have been making some pretty the major competition, Adidas anyway, have been making some pretty silly missteps. And Puma just looks like a disaster. How are you sort of thinking about the kind of competitive landscape?
Yeah, I actually think the competition, I think you're right on Adidas. Rewind 5 years ago and it made a lot of mistakes, but their old Sambas are now coming back. It's like a lifestyle brand, which is by far the biggest category. It's not actually soccer boots that's the biggest category, or runners. It's the lifestyle category. And Adidas' Sambas are actually coming back in fashion. So is New Balances, dad shoes, and those sorts of things. So sales are actually starting to grow at a few of these brands that have been sort of asleep for the last 10 years. What was the other one? Asics. You wouldn't think they're back in fashion, but they are to a degree. And so the competition, has been sort of chipping away in little niches. I mean, obviously we talked about On and Hoka in running, but then there's Lululemon and bunch of other women's apparel brands that have been, eroding Nike's market share there. So Nike's sort of feeling the heat from all sides. I actually think the competitive landscape is probably the toughest Nike's dealt with in, decades, I reckon.
The other thing you mentioned, Nick, which I thought was interesting, was just the change in distribution strategy, this direct to retail. That is often, I would have thought that's an easy way to capture margin, and a business as large and sophisticated as Nike would have no problem with that. You're saying it's not working. Why?
So it did work, and now it's not. So
first of all, we should explain what direct to consumer.
Yeah. So direct to consumer is all about owning the customer relationship by selling more of your products through your channel. So whether that be Nike's online store or Nike's own retail stores. So Nike started to really push this strategy in about 2015. They've cut 50% of their wholesale partners and wound back inventory allocations for companies like Foot Locker. They cancelled their contract with Amazon, and they've really tried to bring this customer in-house. So direct-to-consumer sales have gone from about 15% to almost half of Nike's sales. And this was celebrated for a long time. I mean, Nike earns twice as much revenue for an identical product sold in its own channels compared to one sold in the wholesale channel. So, I mean, there's a lot of economic rationale to roll this strategy out, and many other brands have been. But what they've sort of missed more recently is the wholesale partners actually provide a sort of valuable feedback loop for these companies. They can also, companies can spot trends quicker. And if you're a shopper that's just going to, let's say your local Westfield or whatever mall in the United States, and Nike doesn't have a presence or only has a presence in one outlet, then you're probably going to miss them. And all that empty shelf space has been filled up by these competitors that have, started to gain steam. And so Nike sort of fueled their own sort of, sales decline in a way by leaving all this shelf space to others. So they've more recently, the CEOs announced that they will reinvest in the wholesale channel. So I'm guessing they'll expand their wholesale partnerships again. But it's going to be hard to, I guess, win back shelf allocations if these other brands are selling well.
The funny thing about direct-to-consumer, Nick, is that it's probably hasn't worked that well for Nike, but it reinforces the competitive threat for its competition, because all the new competition coming out from OnCloud and many, many others, all these new brands that are spawned on social media, they use direct to consumer. And that's been one of their key advantages. I just think it's a really dangerous spot when the strategy you're pivoting to is a weakness for you and a strength for your competition.
Yeah, absolutely. And you can see it in the numbers, right? So direct to consumer sales for Nike, I think, declined, I think it was 8% this year, and wholesale revenue was up 5%. So the wholesale channel has actually been taking a little bit of share here, and it's been the first time, or probably the last year or two, it's been the first time since Nike rolled out this direct-to-consumer strategy that they've seen some major cracks in it. And I think at the start, the management team sort of almost dismissed it as, oh, this is just a little bit of a phase. But now they've realised that they've, probably overstepped the mark. I don't want to say that this strategy has been a complete mistake at all. It's definitely worked to a degree and grown sales.
And it was a sensible thing to do. This was the
yes.
obvious sensible step to take.
And they did it far before most of the competition. So so they had a bit of a leg up, but they've just gone too far. They've closed down way too many of their partner or wholesale channels, and it's now showing up in their financials.
It just goes to show how difficult investing is, right? A business like Nike, which has been a global colossus for decades, and almost an assuredly good quality business, is now really struggling. It's a tough business. Investing. It's not as simple as just finding great brands and companies that have been great in the past. It takes a lot of foresight and work to actually uncover what really makes a business tick and what might happen in the future.
It's something I often wonder about is whenever I look at people, investing in fashion, it's, there's an element where it's a bit more like art collecting or something, because you're kind of making an aesthetic judgment on what behavior is going to be. And there is quantitative data you can attach to that. You can look at consumer surveys and all of those things. But I always, when I sort of meet fund managers who have really passionate opinions on a fashion brand, and then, there's sort of such a mismatch in their own personal style, for example, what do you guys think about that? How do you sort of view, because it does seem to be materially different on some level. It's not just a product. And I guess it maybe comes to that point you were making earlier, Gaurav, about it being connected to marketing and how well the product is sold. But, fashion brands, there's just an extra layer of uncertainty, I think, in making an investment there.
Yeah. I think when it's all working, it all looks wonderful. And you never know when it's not working anymore until it stops working. And that's the durability of fashion is what's so difficult, because it looks rock solid until it's not.
Indeed.
Yeah. And when it stops working, it slows down really quick. You get an announcement saying, oh, our balance sheet's bloated with inventory. We're going to have to discount. We're making losses. We have to divest this. It can go bad really, really quick.
And that's how you get a trap forming, because a business that was for a long time performing splendidly suddenly has a speed bump, a hiccup. Valuations come all the way down. Multiples get compressed. And it's tempting to start thinking that this is an opportunity. And I'm not sure that's true. I think most often it's not. It's a warning, not an opportunity. Which begs the question: is that? Do you want to share what is Nike at the moment? Is it a warning or is it an opportunity, Nick? Do you reckon?
My one-word answer would be warning.
Interesting. All right. Well, I don't think that article's been published yet, but by the time this pod is released, it was published, wasn't it? Yeah. So it will definitely be out by the time you're listening to this. Now, another warning comes from Woodside. Woodside, of course, is our largest energy business. It's one of the largest LNG oil businesses in the world. A pioneer in LNG itself. It's made plenty of money, paid dividends, increased production. The share price has gone down for 20 years. If you had bought this stock 20 years ago and held it, you'd collected your dividends, yes, but you are down substantially. And I think that's interesting, right?
Absolutely.
Have you guys ever bought or held Woodside?
I've not. It's a sector which I'm not particularly deep on, and I can see there's a lot of specialized knowledge in it. But I mean, I look at a company like that, and you've got this gigantic asset base, but then the most anemic free cash flow. And, the other thing, when I sort of just look at the kind of the shape of the business, the revenue looks so cyclical, and then there's kind of this consensus estimates that just is steady as a rock. And, I just sort of those kind of imbalances immediately kind of flash little orange lights inside my head.
Yeah.
I've never looked at it either. I think what's interesting actually about Woodside is I can't think of too many businesses this large that are spoken less about in the financial press, like your big banks or BHP constantly in the AFR or whatever. Woodside very rarely is, and maybe its share price decline over the last 2 decades explains a bit of that.
Yeah, it's interesting. I think you're right about the cash flow issues, Angus. I reckon the asset base is huge. It's actually pretty high quality as well. These aren't crappy assets. It owns a portfolio of good quality, low cost LNG producing assets. But these things are just so capital intensive. They require consistent upfront capex. And even when you finished a project and you're kind of harvesting the cash flows at that point, your productive capacity is falling every day. So there's always an impetus to then go off and build the next thing. So I think what Woodside has fallen into the trap of is building a large project and then using cash flow to immediately invest in another large project, and then using that cash flow to immediately invest in another large project. They've gone from a successive massive projects without really collecting too much free cash flow along the path. They're just reinvesting again at probably average middling rates of return. And I think that's one of the key reasons why the share price has not done very much. You've also had a whole bunch of dilution as well, which doesn't help. But that's part of the game here, because the capital intensity is so high. We're talking about sort of $20 billion to build a reasonable sized LNG plant. They went from spending $20 billion on Pluto to then spending probably $16 billion on Scarborough. They've now got a $15 billion project over in the US that they're talking about. They've just acquired and they're talking about building. These are huge capex numbers, even for a business of Woodside's enormity. And it just means you don't get, as a shareholder, lots of cash flows. Now, you might say BHP is business that goes from big project to big project. BHP is backed by an unusual asset. Iron ore is kind of an outlier in the mining industry, because it generates, first of all, the deposits are just huge, and they often last for centuries. You measure resource bases in centuries, not just decades or years. And so you're not really compelled to continuously replace what you're producing. And then the maintenance capex is so small on an iron ore mine. Once you've set up all your infrastructure, you're basically moving dirt around at very low prices and not paying much to maintain your equipment relative to what you're getting. And so you generate these enormous free cash flows, which BHP has sensibly, over the last 10 years, been paying out as dividends. Now, Woodside has been paying dividends. They're a lot more cyclical, and a lot of them have been funded with debt as well. So not quite the same scenario. The reason I really wanted to bring it up today just quickly was because I think there's a vast change in strategy underway here. And I think the market may have missed this a little bit. Yesterday they announced that they're purchasing a $1 billion project in the US. Now, that's small fry for Woodside. It's a $50 billion business. A $1 billion purchase is not very much, especially when you're talking about a huge productive capacity down the line. But what's different about this project is the LNG business model that it requires. All of Woodside's previous LNG projects have come about because Woodside has gone off and explored and discovered massive gas pools. It has then constructed not only excavating, not only development strategies for getting that gas out, but then an LNG plant on top for freezing it and then shipping to export it. So it's done everything from discover the gas, produce the gas, freeze it into LNG, and then ship it. So it's done all that by itself, or with partners, and it's captured margins all along the way during that productive chain. In the US, what they're talking about doing is building an enormous LNG plant, but without any gas pools associated with it. So their plan is to then buy gas from the US market and then freeze it and then ship it. It's a very different scenario. Really, what they're buying and building is a piece of infrastructure. It's not an energy project. And I think the returns associated with that will be a lot lower. So you ought to earn a lower rate of return if you're just building infrastructure and you're buying gas on market. You're kind of exposed to what the gas price is doing, and it's a lot more competitive.
Kind of risky.
I think it is kind of risky, Nick. Yeah. I'm surprised by this strategy, and they're also one thing that was really kind of blew my mind in the announcement, which again I'm surprised that not much more was asked about this, was that they're saying that their returns are going to come from price arbitrage between the Asian market and the American market. They're saying that they can produce LNG in America and sell it at higher prices in Asia. And I just think that's a very boastful, arrogant sort of claim to make. They're trying to be Glencore in moving commodities around and trying to get arbitrage, maximum optimized prices, when for 30 years they've been an engineering business that's been very good at building and developing complex projects. And they're kind of moving from that to being a trading marketing business. And I don't think that leans into what this business is very good at, and it risks returns. And I think the reason they're doing all that is for the sake of size. They're risking a lot in order to get bigger. And
it does seem like that, doesn't it? I don't follow this closely, but the articles I have read on it does seem a bit like empire building. I mean, they merged with BHP. There was rumours they were going to merge with Santos.
Yes.
What
is going on in there?
Yeah, it just seems like they just want to get bigger at all costs. They're, as you said before, reinvesting cash flow into Scarborough, which I think that's up and running, or supposed to be up and running in a couple of years.
A couple of years, about 2 years.
Yeah.
And that is not a high returning project either. That's a middling returning project.
And they're diversifying into this. It's it's quite complicated. Probably explains a bit why the share price hasn't done anything for a long time.
Yeah.
Gaurav, is it that capital intensity that kind of leads to such sort of monolithic businesses? Because you have these sort of super majors, and I assume that's kind of the play here, right? They sort of want to become, like a BP or a Total or, Saudi Aramco, I guess. Is it just because what are the kind of the real advantages these businesses get from getting to that scale?
Look, the cynic in me says that the executives get paid a lot more.
Yeah,
because that really is
great answer.
The big advantage. Because there is plenty of productive capacity inside Woodside. They've just finished the biggest merger, one of the largest mergers in Australian history, where BHP's petroleum business merged with Woodside, and there's lots of things that need to happen in order to make that work optimally. And then I don't think they're giving enough time to pursuing those strategies. There's lots of potential inside that BHP portfolio that they're not fully optimizing. And then they're then developing one of the largest LNG projects in Australia, Scarborough, $16 billion project. And before that's even finished, they're now talking about another $15 billion project in the US. I think strategically, these are the wrong moves. This reeks of a business trying desperately to get larger and larger. And I can't see a compelling reason outside of remuneration why that should be the case. Look, we've owned Woodside in the past. I've owned it personally in the past. We've sold it from the portfolios. I've sold it personally. I'm less interested in Woodside than I have been in years, even though the price is probably cheaper and the valuation is more attractive than it has been in years. And I think that's, following on from our theme earlier, I think that's more of a warning than opportunity.
Two warnings.
Two warnings. So, Angus, that falls to you to either complete the trifecta or change it completely. What do you have for us?
Something I think a little bit more optimistic. So I've been looking at a fairly small company, $500 million market cap, called IPD Group. The bread and butter of this business is really sort of supplying electrical equipment to the industrial sector. They're a third-party supplier, so they're usually sort of working with overseas vendors. There's a bit of supplier concentration. They've got, sort of 16 vendors are doing, sort of 65% of their sales. But they're selling things like switchboards, energy storage systems, switches, electric motors, and then they sort of sell to kind of wholesalers, prime contractors, or sort of power utilities. So some example contracts recently, they did a large electrical fit out for a new very energy conserved skyscraper, doing fast charging stations for the NRMA and doing electrical substations for BP. So they'll do kind of the end-to-end stuff, but then they've also just got a giant warehouse where they're just sort of distributing stuff. What I kind of find interesting in this business is just that they're working in that electrical products industry. If you've ever spent any time speaking to an electrician or God forbid ever tried to plug in something from overseas and blowing up a power board.
It sounds like you're speaking from experience there.
Yeah, there is electricity grids are very, very idiosyncratic. There's a lot of an electrical grid in China, and it's a really interesting kind of historical thing where different countries have developed different electrical standards. They use different voltages. So essentially, there's quite a lot of local nuance in putting complex electric products, bolting them into the Australian grid. And so the company's kind of got, I think, a degree of protection where it's just so complex. And because they also do services. So about 90% of the revenue comes from products and about 10% comes from services. But they've been diversifying their business. They've been rolling up quite a few companies. They're an old business that they originally spun out of British Electric, which built bomber aircraft in World War II and locomotives, and then they got acquired by Alstom, which is that I think French train carriage manufacturer. There was a management buyout from Alstom in about 2005, and then they listed in 2021. It's a small business. They haven't been on the market for very long. So, there's also that kind of slight paucity of data on it. But I just think they're really nicely positioned for, you've got some giants, the electricity grid, it needs to get decentralized. You need more people with rooftop solar. You need, this idea of kind of monolithic coal power stations. That's changing to a quite different energy grid. You've got all sorts of trends like data centers, trends like electric vehicles. And these guys are supplying components to all of those. And they're those sorts of components where, it might be $100. I mean, some of these things, if you're buying like a big switching station, that could be $100,000. But, they're often $100 components where if it goes wrong, it could cost many, many, many multiples of that $100. So there's just sort of that thing where contractors are going to pay a premium to put in a piece of equipment that works and that isn't going to create a bushfire or whatever it is. So I think it's a small company, but I think it's sort of got an interesting position there. Acquisitions that they've been making around, especially electric vehicles, seem pretty smart. I think it's quite a nice. It's got some, but it's also the stock price has quadrupled. So that this is not an opportunity the market's been asleep to.
Interesting. Well, one of the things that really stood out to me from this business, Angus, was the margins here seemed extraordinary for a distributor. I think that's one of the things that really stood out. And second of all, just how niche some of these products really are and how long the customer relationships last for. I think you were saying that they've had some customers have been with them for 25 years.
Yeah, I think the average for the top 10 was 25 years.
Yeah, the average is extraordinary, right?
So that's another thing that potentially kind of gives the business a little bit of protection because to that point, I think the you don't want to be buying some cheap electrical component from Alibaba. That's a risk for so many other businesses. But when it's running to your main power supply and any voltage going wrong could blow out your very, very expensive things that you've got plugged into it. It just gives that little bit of extra protection. And, the business, it's done some sort of interesting things because the profit margins are quite, sort of 40% gross margin around that sort of 38%, but sort of around the 40% mark, and then kind of a 10% operating margin. And, that is high for something that's really just they're often taking these products from foreign manufacturers, modifying them slightly for the Australian grid, and then selling them on. But it's quite usually a business like that. You're probably going to be getting 15% gross margin would probably be good, right? So it is interesting that they kind of can have managed to be so profitable. One of the things that they've done is they've shipped that they have a lot of their services, a lot of their back office stuff and customer support. They've shipped it to Manila and to Colombo in Sri Lanka. So that's one of the ways that they kind of have maintained that profitability, it seems.
Nick, you've looked at a few of these distributor-style businesses, and margins typically look nothing like they do in IPD Group. Are there any general points about distributors that might apply here?
Yeah, I mean, I guess a lot of investors look at distributors as pretty bad businesses. I probably just disagree with that. And I think the reason they look at them as bad businesses is because the OEMs could skip over the middleman and go direct. But to actually do that, you have to create a local sales force. You have to ramp up marketing, establish tens of thousands of customer relationships. If you're a global OEM, you have to do that in every country on earth. It's just a major headache. So no one really bothers, and they give away a little bit of the margins. In terms of IPD, it's interesting because generally I've found the best distributors the bigger moat for distributors is when both sides of the network are fragmented. So you have a fragmented customer base and a fragmented supplier base. So if you look at Ferguson, the Reece equivalent, they earn 30%, 33% gross margins, somewhere around there, and about 10 to 12% operating margins. And they have about 1 million end customers and tens of thousands of suppliers.
And they're almost like a market maker, right? They bring those two groups of people together.
Yeah, and IPD, that's sort of the case. I mean, I think customer concentration is quite low. It's quite diverse, but they're a bit more concentrated on the supplier side. I think ABB, it's 40% of all revenue, and the top 10 customers I want to say is 60 or 70%. So that's a bit concentrated, and that makes me a little bit worried. But as Angus said, I mean, these guys are in the right end markets at the moment, and people talk about like a Dicker Data as a successful distributor, and it's been well managed. It's taken market share. It's done almost everything right. But you have to remember that Dicker Data are an IT distributor, and IT spending's grown at double that of GDP over the last 2 decades. That's been a tremendous tailwind, and I sort of look at IPD and I wonder if it's got a similar tailwind coming with the things Angus mentioned, like data centers and electric vehicles. It's kind of interesting. There's been a few. I think Angus mentioned his article, like the CEO and I think maybe the founding family or someone has sold down shares. So I guess you have to be a little bit careful. But it's definitely piqued my interest. I think it's one to follow for sure.
Yeah, the ABB is really interesting. So 40% of the products are coming from this one supplier, and they're a big player in kind of electrical equipment. They do the Formula E, the car racing. They're kind of the key sort of marquee sponsor and provide a lot of the infrastructure for it. But when your supplier risk is that concentrated, I think what you would see, and a lot of, so they've got the master contractor agreement, the master distributor agreement for doing the ABB makes some of the best EV charging infrastructure in the world. When it is such a relationships business, if that relationship were to go south, you'd probably just get a shearing in the price. And that's, I think, always sort of a concern with this. And one of the things I don't love about this business, they've only got 4 people on the board, 1 independent, and the other 2 are sort of the CEO and I believe the CEO and the former CFO, who's the largest shareholder, owns 15%. And just those 2 guys, the CEO and that original founder, he was part of the management buyout in 2005. There is sort of that key man risk to the business, and when you've got, it's so reliant on relationships with some suppliers, and then you've got a couple of people who really seem to be just so integral. That's something that definitely can add to the nerves a little bit on something like this, I think.
Yeah, and those master distributor agreements, Angus, they're like, it's almost sold by the distributors to investors as this massive selling feature, like we've got almost exclusivity to a company like ABB, but you don't even have to lose them. That's one of the risks, but ABB could come back at the next contract negotiation and say, oh, well, we're going to have 2 or 3 master distributors, or we're going to have, you know what I mean? We're going to expand our distribution list. And this has happened a lot through the industry, either, shrinking a distributor list from 5 to 3 or growing it from 2 to 5. It changes a lot. So, yeah, you do have to be sort of wary of that for sure.
I think what is impressive here, though, is that they've just the way they've grown sales too, because you've had something like sort of 38% sales, 3-year average over the last few years, and it's on a 21 PE, 24 PE. So something growing at 40% on a 24 PE, it doesn't need to do a huge amount for there to be, for you to imagine this thing having some growth, but as I said, it's already run quite far. But the sectors that it's in, I think electrification is it's such an obvious area of growth. They're saying there's going to be 20 times the number of EVs on the road. And I think EVs are such an interesting thing in the Australian context, where you've had an extraordinary amount of political opposition to them. Similarly in the US, but the manufacturers are just going there anyway. So it's kind of like, we recently bought a new car and we don't have a garage where you can plug one in. But we looked really seriously at EVs. And I think it's going to increasingly be the choice of Australians buying new cars. So there's going to be a huge boom in that infrastructure build. And what I like is they've kind of made some pretty strategic acquisitions to be able to do that end-to-end, kind of from the design of the infrastructure all the way through to supplying the parts and then the maintenance cycles. So there's just some nice things here. But, again, it's a small business and not well covered at all. So that's another thing you've got to be mindful too. It's a bit different to the, world's attention that you get on a large cap tech stock compared to a small cap Australian stock.
Now, Jen, speaking of attention, I think ours is probably a bit unwelcome now, because we've been going for almost an hour. We better call it a day with the podcast. But Angus, that is an excellent summary. I'm looking forward to having a read of that. I haven't done that yet. You'll find the research on the website. A lot of it will be locked if you're not a member. So you know what to do. Sign up. Gus, thanks very much for your time today.
Thank you so much.
And Nick, pleasure as always.
Thank you.
And for everyone else, thank you for listening.